Welcome to our introduction to private equity and venture capital, brought to you by Kanjo.com. Private equity and venture capital have grown significantly as an asset class in the last 20 years, and I wanted to create a video to explain what these asset classes really do. How do they invest their money in a unique way? So let's start with private equity. Have you ever heard about a fixer-upper when you're shopping for a new home? Well, that's basically what private equity is. They're the fix-it man of the financial world. They'll borrow large amounts of money to buy large stakes in underperforming businesses. Then they'll use their connections, money, and skills to repair the damage, and once the business is healthy, they'll sell it for a handsome profit or take it public or exit in some way. Many of the world's most famous investors, including energy mogul T. Boone Pickens, corporate raider Ron Perlman, and of course Warren Buffett, probably the most famous, have used this investment technique to generate enormous returns year after year. So this is a very legitimate investment strategy, but there are risks, and I'll talk about those a little bit later in the video. Let's now move on to venture capital, which is really a subset of private equity. But instead of focusing on underperforming companies, venture capitalists tend to invest in newer, high-growth businesses. The venture capitalists then again use their money and experience and skills to grow the company at a rapid rate and get a high rate of return. Venture capital became a very popular investment during the dot-com boom of the late 1990s. A lot of tech companies such as Apple, Google, and Yahoo were all backed by some of the big-name venture capitalists. And of course, these generated very, very handsome returns for the investors. But again, there are some risks, and let's talk about those now. One of the major risks is the managers. All of these funds, venture capital funds, private equity funds, are run by managers. And some managers are very reputable and they have great backgrounds and produce fantastic returns. But there are a lot of unscrupulous people out there. So it's very important to do your due diligence on the people involved in the fund. Who is actually managing the money? Another thing you should think about is leverage. A lot of private equity firms will borrow money to finance their investments. And of course, leverage amplifies the effect of an outcome. So if things are good, they're really good, but if things are bad, they can be really, really bad. So be prepared for wild swings in your returns when investing in alternative investments such as private equity and venture capital. The last thing you got to think about is fees. Venture capital firms and private equity firms charge hefty fees, often 2% of the assets managed plus 20% of the returns. That's a pretty common fee structure, and that's a lot more than you'd pay for an index fund. So you should do your diligence and make sure that you are getting a real return. You are getting some benefit, because a lot of people will just hoard the money and collect their hefty fees year after year. So I hope this video has helped you understand about the basics about private equity, venture capital, and some of the risks involved in investing. Thank you very much for watching. For similar videos, I recommend you check out my website, www.kanjo.com.